Welcome to this week's live strategy session. Thanks for joining me. Great having you with me for another show. Heaps of interesting things to talk about this week with a whole lot of movement in the stock market. Also, some of the commodity markets moving around quite a bit as well. And of course, at the end of the show, I want to look at all the stock codes that you'd like me to have a look at, get a technical idea of what some of those stocks are doing, what might be coming next. As always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's jump into our first chart. And I have the ASX 200 up here on the screen. And after a 2-week reprieve, volatility is back, and it's back in a big way. After a positive close on Wednesday, you can see Wednesday prices closed up near their high. From there, they then gapped lower on Thursday, and now here we are on Friday with prices hitting an 8-month low this morning. So how much worse could this get? Is this the early stages of a larger bear market, or could it all blow over in a relatively quick period of time? I'm going to talk more about that in a moment, and I've got some fascinating statistics that I want to show you that give an idea of what the rest of the year might look like, and I think that could surprise you. But let's start with this latest price action. Last week we spoke about the inherent weakness in this price structure, and that was that we had a shallow bounce off the March low, and that bounce was seeing prices consolidate below the declining moving averages. I've got the 50 and the 100-day moving averages. So that was a key shift. It was a key shift in the price structure. So with that, the environment changed. It changed from having consolidations above rising moving averages, like we had for pretty much all of last year, to consolidating below declining moving averages. And that creates a vulnerable structure. And this is where there's a higher risk of rallies being sold, which is, of course, what we've just seen in the last few days. I think it's really important to just step back for a moment and just think about the price structure around the moving averages. I think this is a really important distinction to understand. Buying dips generally works well when prices are above rising moving averages. But when the structure flips, buying dips, it just carries extra risk. And that's because the money flow often shifts from buying rallies, as we've seen last year, to selling rallies, as we're seeing now. Doesn't play out every single time, but that's where the flow tends to shift to. And that's something we've been discussing over the last couple of weeks. I think we should be ready for more downside in the near term. And I say that when I look at the S&P 500, and we'll go and have a look at that in a moment. The S&P 500 closed on its lows on Thursday, and I think that's a sign that there's more selling to come in the US, which of course will likely have a flow on to the local market. The ASX 200 has a significant support. You can see this blue shaded area on the chart. Comes in at around 7,600. It takes in these high points from 2021, 2022, as well as quite a bit of activity through 2024. So far, that's holding. We look at where prices are today. You'd look at today and go, look, today's not so bad, given what we saw overnight in the US. But I think that we could look at this and say, look, that's somewhat encouraging, but it really just seems to be a few of the big stocks which are making today look better than it actually is. Quickly, just jumping over to the equal weight, the ASX 200 on equal weight basis. So that takes out the stabilising effect of some of the big stocks like CBA, which are doing okay today. But when that's reduced to one stock out of 200, as well as some of the other big stocks which are doing okay, you can see what the equal weight has been doing on Friday. And I think this gives a better picture of what's happening across the individual stocks within the ASX 200. It's had a big break of support. It's broken below this key support that comes in at around 1,800, and I think in doing so, it's taken prices down to a 14-month low. It remains in a really weak position. What I want to do, I'm just going to come back to the. Let's just quickly come back to the ASX 200. What I want to do now, I want to put on an indicator. So this is the percentage. It's an indicator. We've looked at this before. It will show the percentage below or above the 50-day moving average the market currently is. Let me just compress this a bit, and I'm going to run a marker along. I'm going to get to 6%, where let me just run this across. I could go quite a bit further back. I did this a couple of weeks ago, so you can go back to 2 weeks ago if you want to look at a more detailed view of this. And so this is interesting. So this shows that when this shows how far the ASX 200 is below its 50-day moving average. So it's currently about 4.5%. Was recently about 6%. We looked at this a couple of weeks ago, and it gave a good guide to the March rebound. And that's because when the ASX gets stretched about 6% below its 50-day moving average, there's a tendency for a snapback rally, as we recently saw. But as we also discussed, it's not uncommon following that sort of rebound and following this rebound back towards the moving averages. It's also not uncommon for prices then to retest the lows after an initial rally. I'll show you an example from not too many years ago. It was during 2018. We actually looked at this example a few weeks back as well. So there's this initial sell-off. Market gets stretched to the downside. You can see it has this move back towards this 6% region. Then there's a bounce. Then there's a secondary sell-off. Not just tests the low, it also breaks the low. Takes a bit of time for the market to stabilize and actually put in a final low. And it's that retest which we're currently seeing when we go back to present day. Now, I think this 2018 period, I think this is particularly interesting. The ASX 200 it's a 15% sell-off from a multi-year high down to the low about 3-4 months later. It's around a 15% correction. And what was one of the leading issues of this period? Well, I'll tell you, it was trade wars and tariffs. This time around, the tariffs are on a much larger scale. But nonetheless, I think this is a really interesting period. There was an initial aggressive sell-off, considerable panic. It played out over several months. It wasn't a one or 2 day or 1 or 2 week situation, but it didn't lead to a long-lasting bear market. I think it's entirely possible something similar could happen this time around. So let's go back. Let's just zip back to current day. So let me put a 15% decline on this chart. So far, this is 9. What's this? It's about touch over 10%, coming out to 11%. This is where 15% would be, the bottom of this shaded area. So of course, this period it'll be different. It'll be entirely different, but this is where a 15% decline could come to. If that were to happen or something around there, it'll have its own unique price action. But just to give some sort of idea, historic parameters around the types of things that can happen. So yes, I think we should be prepared for more downside. That's what we've been discussing over the last few weeks. But the worst case scenario of a lengthy bear market is by no means inevitable. As I said last week, we need to appreciate that this is a vulnerable structure as things stand, and we should play accordingly, and we should plan accordingly with the way we approach risk. I'm using wide trailing stops across my portfolio. I tell you that all the time because I think it's such an important strategy to be able to use. And of course, the aim is to see off consolidations where possible, but then to have an exit plan should things continue to deteriorate. And I don't want to this is another important thing. I don't want to let my losing trades get away from me. This can be an incredibly punishing environment for those with poor risk management. Losing trades, you think, oh, look, I'm going to give them a bit longer. In this environment, they can move a long way quickly. So I don't want to let my losing trades get away from me. Now, we're going to look at the US next, but first of all, if you're getting some value, please hit that like button. Please leave a short comment. Just, hey, thanks to the video. Tells YouTube you're watching. YouTube shows other people. Helps me heaps. So please do those things. And just click that like button now, just so you don't forget later on. All right, so let's go over to the S&P 500. So this is the biggest single day fall in the S&P 500 in nearly 5 years. You've got to go back to June 2020. So this is during the recovery from the COVID crash. You've got to go back to June 2020 to find a bigger single day decline. Another alarming statistic is that the S&P 500 is down. So if you go back to the beginning of the year, so from the beginning of the year, the S&P 500, it's down 8.3% in the first 63 trading days. And that is the 8th worst start of the year ever. So I'll come back to this in a moment. There's a bit more to this, and there's some interesting stats I want to show you. It's really, actually, I think it's fascinating. We'll come back to this in a little bit. I want to start by focusing in on this week. This week's been significant for a few reasons, and not just for the big percentage falls. You'll probably remember we looked at a 200-day moving average last week. So let me just take off the usual 50 and 100-day moving averages. I'm going to quickly go to my indicators and put on a simple 200-day moving average. So we talked about this last week. When we go back over the decades, I won't do that now. You can do that from last week's video. When you go back over the decades, brief dips below the 200-day moving average can quickly reverse. And just a couple of quick examples. You can just see these brief touches below the 200-day moving average. They can quickly reverse. So not such a big deal when that happens. But excursions below the average that last more than a couple of weeks, they typically lead to, at best, multi-month periods of difficult conditions. And I'll show you what I mean. I'll come back to, we looked at 2018 on the ASX 200. Here's 2018 on the S&P 500. So you get these declines that hang around under the 200-day moving average for more than a couple of weeks. They tend to turn into larger stints below the moving averages. So that's 2018, and another good example over here, 2015. If it doesn't rebound quickly, there's another quick dip, quickly back above. If it doesn't rebound quickly, it tends to get stuck beneath there for at least a few months. That's this is where we currently are now. I think with the S&P 500 making a new low on Thursday, breaking the previous low from around middle of March, breaking to that new low below the 200-day moving average, I think the odds now just intensify that this isn't going to be a short, sharp correction. Rather, I'm thinking our best case is likely several months of messy consolidation with further downside risk. Let me quickly go over to the equal weight. I'm going to look at the S&P 500 on an equal weighted basis, like we did with the ASX. So another significant development this week is that the equal weight now has a series of lower lows. So up until yesterday, we just had up until yesterday, you could have said this is a zigzag consolidation and prices could start to recover. I don't think we can say that now, because now we have three low points. So we have a series of lower lows. We have a series of lower lower highs. And that's in addition to being below. Let me just switch our moving averages back. Just going to put the 50 and 100 day averages back on again, and that's in addition to being below these declining moving averages. So there's no sugarcoating it. This is a weak structure, and it's just gotten weaker with Thursday's decline to a new low. And I don't think the selling has finished quite yet. I'll show you why I think that. I'm going to get another indicator. We haven't looked at this one for a while. What this one does, it shows the percentage of stocks below. Where is it? I should have had it ready, but I forgot to get this one. Here it is here. This shows the percentage of S&P 500 stocks below their 200-day moving average. And now I'm just going to do a little bit of adding and compressing. I'm going to put on a S&P 500 graph up the top, just so we can just talk through this a little bit. So currently what we have is that there are currently about 29% of S&P 500 stocks are above their 20-day moving average. Now, what often happens is that notable lows in the S&P 500 mightn't be a final low, but a notable low. So it might be a low before like a significant rebound. Notable lows typically involve a washout and you can see this blue band I've got across here, blue line at around 10%. So look at the times where 10%'s been hit or nearly hit. So these notable lows typically happen when there's a washout, and that's where nearly every stock is below the 20-day moving average. So just looking back at some of these, you just quickly line them up with your eye. These washout moments tend to mark these low points. What we have now, this isn't what I'd call a washout, 29%. Now, it's not to say that this has to get down to the hard deck, down to the blue line, but it is a tendency for, as you can see, we can compress this chart. You can go back further, and we can keep doing this. The washouts below 10% tend to be notable lows. They can occur elsewhere, but I think this is a reason to think there could be some more downside before we get a meaningful rebound. So I think there's room for this to go lower, as we've seen in just about every notable low point. Yeah, you get that big sell down. So let's before we finish up on the S&P 500. So this has all been pretty gloomy, what I've been talking about with the markets. And look, I know that I don't want to be overly alarmist, but the price action is what the price action is. We're not talking crashes, but we're talking about we're in an unfriendly environment, which we need to, I think we need to respect. But let's finish with something which is a little bit more positive. I saw some interesting stats yesterday. What it showed was the worst 20 starts to a year and what happened over the remainder of the year. So you might remember I said this year is the 8th worst start to the S&P 500 ever. So let me show you something. This came up on my X feed. It's from a guy called Charlie Billio. He puts out some really good stats. I like looking at some of the stats he comes up with. So this is the S&P 500's worst performance through the first 63 trading days. Goes back to 1928. S&P only came about in 1950, so I guess he's using reconstructed data or using the Dow or some other way to go back further than 1950. But nonetheless, here's 2025 coming in 8th position as we discuss. So out of 20 ugly starts by the end of the year. And so this is the end of the year, and this is what happened between now and the end of the year. So by the end of the year, out of those 20 ugly starts, 12 were in the green. You can go through and count them all up. 12 were, I think, oh, this must be here, for the rest of the year, making positive territory. 12 made positive territory. 7 continued to lose. And of course, we don't know where this one fits in yet. So that would make our 20. And of those where there were continued losses, so of those 7 where there was continued losses, only 4 got a lot worse by the end of the year. And you can see there's one's 9.4%, 12.8, 11.5, and there's the worst one, 34.9. That was during, of course, during the GFC. Now, could we get another GFC type period? Well, absolutely, we could. Anything can happen, but the odds are probably against that occurring. So there's a bright spot. Things can start ordinarily, but often they finish a bit better. There's there's no doubt about it. There's certainly been a lot of technical damage done here. As I was saying with the ASX 200, I think now is a time to play defensively, respect risk. This is all about caution and knowing your exit strategy and being patient with buying at this point. At least it is for me. As I say, a lot of technical damage done. It will probably take time to repair it. That's why when we looked at that 200-day moving average study earlier, when you get these deeper runs into negative territory below the average, it often takes several months before things can at least stabilize. But just remember, every tough period leads to new and profitable opportunities. This is all part of the process. This is the price we pay for being involved in the stock market and having the potential for those big gains during the positive periods. And these opportunities which are on the horizon at some point, that's something to be ready for. Make sure you protect your capital during this less attractive period. Okay, so we're going to jump over to the US small caps next, the Aussie small caps, the commodities, all the stock codes you want me to go through. That's all coming up next. But of course, that wraps up the free section. If you're not a Strategy Session member, there's a link below. Click that, come on in. Of course, you won't get the rest of the live session, but you'll be live for next week and you'll get the replay of everything else that goes on today. So it doesn't cost you much money either. So think about doing that. All right, let's go over to the Russell.